Hello, everyone. Welcome to this webinar. Equity markets teach us lessons in every phase, and we have seen that in 2018-19. We are seeing that now. We have seen that always in the past. Many thought leaders, out here who have been coming here, have always reminded us that equity markets teach you old lessons in new ways, and hence, a fund manager who is flexible and is able to adapt to the new ways of equity markets is able to actually, give good returns. At present, equity market is kind of seeming to be confused between value and growth. We have been hearing various fund managers who have been talking only about growth and have been very casual about valuations. And their claim has been that valuation for growth businesses, do not matter. And beyond a point, it is the growth that matters. But at the same time, now we know that over last around 5 years, there have been many very good, growth businesses where valuations were obnoxious. Valuations have been very high, and investors actually have been invested into those businesses with a lot of conviction. But some of those businesses have actually fallen over last 6 to 8 months when FIs have been selling. Now, obviously, some of those business were darlings of equity markets have fallen by almost 20-25%. It makes the case all the more interesting and attractive for those companies because they are obviously, good businesses with great growth. But at the same time, there have been many other businesses where there is a value still, but their growth story is also intact. At the same time, they may not be the best business in the respective industry. So there is hence this tussle going on in the minds of investors whether they should pick some of these best consistent growth stories, or should they kind of understand where market is headed from the recent correction of these high value consistent growth businesses and try to navigate the future into equity markets with more fine strategy. We want to understand this in detail from a fund manager, Mr. Naveen Chandramohan, who also follows growth investing, but within that, he also very finely understands and executes the cash flow growth, which provides a cognizance of valuation as well. Hence, his philosophy is following growth at reasonable valuations. Let me also spend 30 seconds and tell you that the numbers for the month of May for the entire PMS industry are out, and almost every PMS has given negative return in the month of May, and returns range from around -4% to -10%, and many growth businesses, many growth focused, I would say, PMSs, which were less cognizant of valuations, have actually fallen around 10%. Obviously, this is the part and parcel of equity markets, and we are not trying to kind of create a fear around here. In fact, we want investors to always focus on a more positive aspect, which is returns and not the risk. But obviously, it is important to understand where market is headed, and that is where we thought of doing this detailed discussion on the way forward. That is why we have kept the topic as collection between growth and value. And is it a time where we can say that growth is down and value is coming back? Over to you, Naveen. Naveen has made actually a very interesting presentation, and warm welcome to you, Naveen, once again. And over to you. Once you give your presentation, and then we will do Q&A.
Sure. Thanks, Kamal, for setting the context to this conversation. And like you said, what I'll do is basically share a brief presentation. It's just a small set of slides that's been put together to set the context to our conversation. So, Kamal, you should be able to see the screen. Just confirm.
Just change this to the slideshow mode.
Sure. So obviously the world is going through a normalization stage today, right? What do I mean by normalization? I think the last 2 years has basically what it effectively did through excess liquidity was for people to chase businesses at any valuation. And unfortunately or fortunately, as humans, we look at confirmation bias around our decision making ability. So when you buy a business whose price keeps moving up, you tend to believe that you made the right decision. So you look at price as a confirmation bias to around your decision making ability. And that in general results in issues over time, especially when you are driven by a liquidity driven environment around what Fed did and around what global central banks did. So like you said, the topic was is growth dead, and is value actually the way forward for things? So what I wanted to do was, unfortunately here, right, we've used growth and value in a very in a way which is interchangeable without understanding where it even came from. Now, because of US being the home of capitalism and having much longer history, the words actually value and growth have been borrowed from the US into the Indian context. So if you look back in 2011, right? So this was an article written back in 2011, where Google was actually called a value stock back then, right? And obviously today, in 2021, which was roughly around 1 year, if you rewind back, Google was in the middle of a very structural upturn over the last 7 years, and in the last 2 years, that was exacerbated because of liquidity as well as the growth coming in, right? So the same stock over a decade suddenly turned from value to growth. Now, through this, what actually happened to the business? Let's just look at it, right? Over the last 8 years, Google stock went up almost 5x. And that 5x came predominantly because of the actual revenue per share growing up 4x and some amount of re-rating in the stock. So why did you get consistency in shareholder returns in a stock like Google? Was predominantly because the valuation that you got as a minority shareholder came predominantly from fundamental earnings growth or cash flow growth rather than re-rating growth. And it's very important to understand the difference between the two, right? So when you basically talk about the so-called consistent businesses that keep going up every year after year, very rarely does one look back and ask, did this so-called IRR get generated because of cash flow growth, which is fundamentals, or second, because of market re-rating the businesses? When you have your cash flow growth structurally growing and valuations not re-rating itself in a significant way, the possibility of you getting drawdowns north of, you spoke about 25% drawdowns, Kamal, most likely it's been 50 and 60% in most cases, right? So you will get into such scenarios when valuation is not being paid attention to. So let's just put this so-called 2 years into context, right? So what we have done here is, so the last 4 years has been a resurrection of the SaaS-based businesses or digital-based businesses. So we've basically taken businesses in the US and looked at the top quartile, bottom quartile, and the blue line is the median of all of these businesses. Total of around 450 SaaS-based businesses being allocated in the top quartile, bottom quartile, and the median. So look at what happened to the valuations. The average EV to sales multiple that US businesses, which were SaaS-based businesses, were trading at was between 5.5 to 7 pre-COVID. And with the infusion of liquidity, this basically shot up almost 3.5 times. So what you are seeing in terms of normalization of this is the valuations reverting back to mean, which is what generally happens to the markets. The same thing can be extrapolated to our Indian markets as well, where most of the businesses where you are willing to buy it at any valuation is now mean reverting because the situation has changed from a liquidity perspective, right? So in the middle of the party, you obviously don't know when the party is going to end. And because of the fact that you feel good in the middle of a party, you wish it never ends. But unfortunately, life doesn't work that way, right? So now coming back to the Indian context, and here again, I want to give you a misnomer. So NSE, right? NSE actually has, it comes up with what is called smart beta indices. And there is, and I would urge investors to look up this index. You actually have passive indices in India, which replicates the value index of NSE. So what they do is they pick up the top 20 value components of Nifty 50. And interestingly enough, it outperforms Nifty over 4.5% over long periods of time. And if I was to actually, without telling you the constituents of the index, right, ask you, what would you guess as the weight of the financial services index? Because if you are, Kamal, you are close to the market, and many investors here are obviously investors in the market. And the big theme today is financial services offer huge amount of value. So if you look at any MF, any PMS, any AIF, there's a big weight towards financial services, right? And also tech is thought of as growth, right? So one question that I'm not going to answer, and we'll take it up in the Q&A. What do you think is the weight of the financial services index in the value component, and what is the weight of the tech in the value component? Hold that, and I'll come to it later, right? So just to basically think about what is happening, we are in a world where we are normalizing into a world of fundamentals. So how do we think about businesses? We don't think about businesses whether it is a growth business or a value business. We think about businesses from three lenses. A, is the business able to grow its market share? Is the business able to grow its cash flows? Is it reasonably priced? What is reasonably priced? So I'll just give you metrics, right? Many multiple businesses, multiple funds owned businesses with this kind of a flavor. Price to sales multiple was north of 10. The growth rate of the business was not more than 15%, and the competitive intensity in such businesses was fairly significant, right? So your PAT margin is not more than 10%. If that's the kind of businesses you own, it's very hard to justify these kind of valuations. So end of the day, what I would want to conclude before we go into Q&A, there are only three things that will ultimately matter to future returns. A, the investment that you make or the business that you own, does it have the ability to generate cash flows? Because if it does, you are entering a business which does not need to borrow significantly to grow. Incremental capital actually matters. How does the management or promoter think about it? Valuation is always an element of subjectivity. Fund manager A might tell you it is cheap, fund manager B might tell you it's expensive, and that is where a certain level of discretion comes. Otherwise, end of the day, all of our jobs will be taken over by systems, right? But there is a framework that you can always think about rather than saying that I will just buy because the price is going up. So if I was to put Itus's own portfolio into these metrics, so if you look at it over the last 2.5 years, the consistent attribute that you would find in our portfolio is the return on incremental capital continues to expand. And even though the operating margins are slightly lower than what it was a year and a half back, it still has a significant, almost 2x the operating margin of Nifty, which basically tells you the pricing power of the businesses that you tend to own and the portfolio that we run.